Greetings of the day, a very good evening to all the partners present here today. Thank you so much for taking out time. And my promise to you is that this time that you've given to us today on Distributors Digital Meetup is going to be worth it. Today, our investment team is going to present an alternate strategy to SIP, and it will be worth your time. I'm Chirag Joshi, the Chief Growth Officer at Samco Mutual Fund. And today on this digital meetup, I have Mr. Umeshkumar Mehta with me, who's the CIO of Samco Mutual Fund. This strategy that is about to present retains the features and benefits of an SIP, maintains the discipline, yet potentially can generate alpha for your investors over the long term. I would request Umesh ji to take over the stage and take us through the strategy. Welcome on the webinar, Umesh.
Thank you. Hi, welcome everyone. Indian stock markets have become magnets for returns. Not only our retail investors are excited, but even foreign investors are equally excited. We have seen all-round buying, but small and micro caps have stood out in terms of returns in last 4-5 months. So now markets are at all-time high. Is there a euphoria building up? Is herd mentality working at its best? Everyone is buying, I also want to buy. So we will analyze factors that are relevant today. If someone wants to invest today, what the situation is, that we will discuss. So what I am going to cover in next 20 minutes. First, global macros, ultra long-term interest rate cycles, China economic dashboard, and what's happening out there in US. Second, I'm going to discuss, is this the right time? Nifty at the rate 19,500. I will share India perspective. Third, I'm going to share what smart investors will do or are doing during such times. And lastly, I will cover alternate strategy to SIP, which can generate alpha. So this is what I'm going to cover, and permit me, I can, if I can share my slides so that I quickly get into the business. Yeah, I hope my screen is visible. So alternate strategy to SIP. This is what is the crux of the topic, and this is what I have shared. These are global macros. This is the right time to invest. How do smart investors invest? And alternate strategy. These are the 4 broad topics that I'm going to cover today. Let's understand global macro. So this is interest rate cycle since 1870. Now what you can see, save and except last 40 years. Prior to that, if you see in America, USA, interest rates were hovering around 5%. It is only since last 40 years that interest rate had an upside of around 13-14% and then back to zero. But save and except last 40 years, the previous 100 years, the cost of money or the interest rate across the world was around 4.5-5%. So currently, interest rate in US is at around 4 and 4.5%, the 10-year yield. This is what the reality is. We are biased of history of last 30-40 years, but prior to that, this is the normal that 4-5% interest rate was prevailing during that time. So currently, let's understand the leading indicator, 10-year US Treasury bond yield. That is flashing a red signal. So back then last year or the beginning of 2023, when interest rates were here, everyone was estimating that this is a probable peak and interest rates will fall. But to surprise of everyone, even the central bankers, interest rates are starting to rise, and they are going at newer highs. This is a cause of worry, and this is what the reality is. So now let us understand why interest rates are rising in US. Next slide will make things absolutely clear and is the least talked about data. If you see, long-term trend of China shrinking US Treasury holdings. So the day Xi Jinping came into power, the reserve, US Treasury reserve of China was around $1.3 trillion. Continuously, the reserves are falling, and they are today at around $800 billion. $500 billion China has sold, or it is not investing in US Treasury. This by far means what? Countries around the world, not only China, Japan, other countries, even Saudi Arabia, they don't want to finance US deficit. Because they don't want to finance US deficit, interest rates are rising, they are not comfortable, and therefore cost of money for US as a country is rising, because if everyone lends US, the interest rates will fall. If you see the long-term trend, China, Saudi Arabia, Japan, all these large economies are now unwilling to finance US deficit, and this is what the reality is. So now let's understand China's economic indicators. So last 20 years, industrial production in China is steadily falling. Property investment earlier was around 30%. Now has become negative. People are not investing in property. If you know, China has 1 crore surplus household units to be sold. My friends, 1 crore is too much. India has 4 lakh. India has only 4 lakh housing units unsold inventory. China has 1 crore. This is too much. Retail sales, the growth rate has fallen to sub-zero. Earlier, the growth was around 15%. Fixed asset investment as a percentage of GDP is also down. So China is into a structural downtrend. So now let's understand one more data point. In US market, how large cap and small cap have performed post Russia-Ukraine war. So if you see, the orange line is US small cap index. It contains 2000 stocks, and the blue line is S&P 500. There is no euphoria. And my friends, you will be surprised. Nowhere around the world, there is euphoria in small and mid cap or micro cap stocks. It is only in India that we have seen such massive run-up across in all sectors of stock. So Nifty at the rate 19,500, is this the right time to invest? And this is what the question everyone says. So now let's understand the India perspective and the fundamentals behind. So this, my friends, the orange line is again S&P CNX small cap index. And this, if you can recollect, this is 2017-18 period. And in December 2017, this same euphoria was there back then. The returns were almost double. So small cap index had delivered 62% return, and Nifty had delivered 32% return. The return was almost double. And you know what? After that, what happened? Some of you might have those memories. This is what happened. So during that time, few of the mutual funds, I am not naming one, but this was the trend during that time, that mutual funds had suspended new funds in their small cap category. And this is what happened thereafter. So this is what is the peak euphoria I was talking about in small cap and Nifty. The difference was almost 100%. And this is how it ended. Thereafter, the small caps had corrected, but the larger market was there it is. But it was only the euphoria that got corrected. And this is how this was the reality of 2017-18. Now, will the history repeat itself? If I may ask you all, answer is, this is the current state of market. The small cap index currently, the returns between Nifty and small cap index is almost double from a major bottom of Russia-Ukraine war. So major intermediate bottom. So here also currently the same situation is happening what we saw in 2017 December. Again, one of the large fund house has closed fresh subscriptions in small cap fund. In their wisdom, they think that small cap as a category is overvalued. Back then in 2017 December, the wisdom of fund managers were that let's not take fresh inflows. So this is what the reality of today's situation is. So let me tell you, so of the entire market, small cap is a small, insignificant portion when we see the entire market. But because there is a lot of euphoria, there is a lot of talk around, people think that, oh, wow, this is a great category. But obviously, there has been overheated, markets are overheated. But the general market, the larger market, is still fairly priced, reasonably priced. Only this pocket has become red hot. So now let me, before coming to next slide, let me tell you one thing. The next slide is the most important slide for everyone, because if we miss that, we will miss the longer term rally, the biggest wealth that India is going to create for next decade. This is the reality. So let me show you why we think that this is a decade of India and we have to remain aggressively invested. So India offers best demographic dividend. So let me explain. First of all, Japan. So Japan, the demographic dividend. So by the time the median age of Japanese was around 40, the peak in economic growth was behind. So as population, as the age increases, the economic growth slows down, the drivers of growth slows down, and there is a slowly contraction in economy. So this is the Japan. So now let me come to China. So by 2031, it is estimated that the demographic dividend of China will, by that time, will be over. So the median age of China by 2031 will be 37. And this is what, when the economy reaches at 37, 38, the slope, the economy progress at a slower pace, and therefore the stocks returns are also muted. So now let's come to India. The average age that India will reach, the median age of 37, will be by 2055. Today, what is the median age of India? 28, or some people may say 29. So from 29 till 37, we have 2055. This is what the ultimate. So next 2 decades, 3 decades belongs to India. We have to remain aggressively invested in India. No other large country has got this type of potential. Therefore, although certain pockets of the market may look expensive, as I told you, small cap, but largely markets are very attractive, and we have to ask our investors that, look, do you have to remain aggressively invested in India? So now, how do smart investors invest? Given that there is euphoria in certain pockets of market, given that markets are euphoric, obviously without any correction, your indices are having one-way rally. So how do you approach? Today, if you have money, how will you invest? So here comes the traditional wisdom, margin of safety. So introducing EMOC, Equity Margin of Safety Index, which we Samco, we are already running this. And today, at an aggregate level, at market-wide level, the valuation is moderate. So now let me tell you one thing. Either the markets can go this way or the markets can go this way. The odds that markets are richly valued, certain sectors are very hot. Therefore, the odds that market will correct or the valuation will become reasonable are more compared to markets can still go higher. There is no stopping, and market is in own has its own wisdom. But I've told you the headwinds that we have seen in US, the headwinds that we are seeing in China, the slowdown, entire Europe is in a slowdown. Nowhere in the world markets are so euphoric, just like India. Therefore, the odds in India that India will tilt towards softer correction, valuations will become attractive. Currently, they are at neutral or neutral level. So the odds that margin of safety will increase. So this barometer is likely to fall below, and therefore that will get investors a chance to deploy more. So now let me explain you straight what is EMOC and how it works. So EMOC has 5 zones, basically 5 categories, wherein it defines when margin of safety is high, it is time to aggressively invest in market. The global financial crisis, markets were down and EMOC readings were very high. The green color that you see, it's time to aggressively invest. During global financial crisis of 2008 January, market valuations were very high and therefore EMOC readings were low, margin of safety was low, and it's time to invest cautiously or get out from the market. So this is how this entire period of 22 years we have mapped, and over here when Russia-Ukraine war happened, markets were attractive, and during the recent fall, markets had again become attractive. Now the EMOC value is around 0, it's neutral. So currently the Nifties and the large cap stocks are fairly valued, but obviously the smaller component, the smaller cap companies are richly valued, and there the margin of safety is little less. So what has gone in making EMOC? So let me briefly cover that quickly. So macros that we cover, GSEC bond yields, price to earnings, price to book, market cap to GDP, and bond yield spreads. We also use technicals. So we use moving average divergences, standard deviation, market breadth indicators, put call, volume, volatility ratio. The EMOC is very nimble and it quickly turns depending on where the market is. So the benefits of all the benefits of SIP, discipline, the regular investments, power of compounding, no stress, everything is there. Plus, when you do timer STP, there is a potential for alpha. So now let me explain why we will be able to generate potential alpha during this time. Assuming that markets remain at this level, at elevated level for next 2-3 quarters. So in timer STP, STP concept, you all know that a fixed amount will get invested every month. So in timer STP, if the margin of EMOC value is 100, so standard installment will get invested in the equity scheme. So assuming 1 lakh is the installment amount, a 12 lakh amount, lump sum amount has been invested, 1 lakh every month will be invested. But if markets fall, if markets correct, and there is likelihood that there 2-3 months down the line, election noise, maybe the interest rates, the impact of higher interest rates will be felt. Maybe the developed countries, some of the developed countries can go in recession, elections in America. There are so many factors. If markets fall, when an investor uses timer STP, because when markets are down, a larger installment will get invested in market, and that is how it will generate potential alpha. Let me share a live example, a detailed example, which will make things very, very clear. So this is since last 1.5 years. These are the installment amounts. So here, when Nifty was higher, the installment amount was 0.6. So assuming 1 lakh is the standard installment, only 60,000 will get invested because markets were high. Here in June 2022, when markets were attractive and markets were down, the installment was 1.8, meaning 1,80,000 will be invested, provided 1 lakh is the standard amount. So this is how, when markets were high, the installment is low. When markets are low, the installments are higher. This is the beauty of timer STP, and this is the beauty of our EMOC. This is the beauty of our multiplier that creates potential alpha. And this is when we overlap this EMOC on our Samco FlexiCap, the target equity scheme, this is what the kind of number, and permit me if I can share those numbers with you. So as our Samco FlexiCap scheme started on 9th of February, an investor started timer STP during that time, and an investor started SIP during that time. See the difference of return. Timer STP has delivered 16.27% return, and SIP has delivered 12.29% return. So this is what the optionality. Assuming that if markets come down, investor will be able to generate higher alpha because the installment amount will increase. But if markets keep on, it remains at this level, even the SIP return will come because the installment amount at around 100 will be more or less equal. So timer STP creates an upside potential or optionality in the investor's portfolio. So these are the numbers XIR return for timer STP, 16.27%, and for SIP, 12.29%. So now let's understand. Today, investor invests in our underlying businesses, the FlexiCap portfolio. And so now let's discuss the underlying strength of our portfolio. Till now, what I have covered is the broad aspects of timer STP. Prior to that, I have covered the macros, interest rates, cycle is the China economic dashboard, and where India and US market stands in terms of small cap and large caps. So we are underwriting the 7 business verticals for compounding of our shareholders' wealth. Cloud and digital, we have TCS, Coforge, LTI, Mindtree, Microsoft. Financializations of saving and lending, we have Bajaj Finance, Finserv, Aditya Birla Cap, and ICICI Lombard. On the consumption side, we have Jubilant Foodwork, Dabur, Crompton Greaves, and Godrej Consumer. Proxy for infrastructure and auto, we have Supreme Industries, Pidilite, Asian Paint, and Balkrishna Tires. Software and innovative technology, we have LTTS. And for platform and oligopoly businesses, we have CAMS, Meta, Alphabet, Mastercard, CDSL. Healthcare and pharma, we have JB Chem, Divi's Lab, and Novo Nordisk. So now let me give you a consolidated view, fundamental numbers of Nifty 500 and our Samco FlexiCap. So these are our latest numbers. So accounting return on capital for our universe of stocks that we hold in Samco FlexiCap is 28.18%. And this for Nifty 500 at an aggregate level is 20.21%. Adjusted ROCE 32%, 22% for Nifty 500. Return on invested capital 23% for Samco FlexiCap and 17% for Nifty 500. Gross margin again for FlexiCap, it's around 61%. For Nifty 500, it's 46%. Debt equity is lower. In FlexiCap, it's 0.19%, and Nifty 500 is 0.59. Sales growth, 5-year sales growth is around 19% for our FlexiCap, and Nifty 500 is 13%. PAT growth 15% and 12%. So this is how, when an investor uses the magic of timer STP by timing the market and has a solid underlying portfolio, when he invests in solid businesses, the compounding will happen. We'll take the advantage of timing as well as the underlying strength of the compounding businesses. So coming to the financials, pre-tax return on equity of our companies that we hold in financial sector, Samco FlexiCap has 30% return on equity, Nifty 500 has 25%, and capital adequacy we have higher, our companies have 21% compared to Nifty 500 20%. And lastly, this point is very important, the valuation. Free cash flow yield for Nifty 500 is 1.82%, and for Samco FlexiCap, it's 2.23%, meaning every 100 rupee will generate 2.23 rupees at the end of the year for Samco FlexiCap, the cash that it generates, and for Nifty 500, the cash that every 100 rupee invested will generate 1.82 rupees. Therefore, valuation-wise, our portfolio companies are very attractive. And on top of it, if we apply timer STP, and depending on where the margin of safety is, investors will be able to generate far a higher alpha when he thinks from 3-5 years down the line. So this is not time for tips, it is time for timer STP. And this is what we say, that investor has to remain invested in solid companies, remain invested in India. And so these are standard disclosures. Before I conclude my part of presentation: performance of our Samco Flexi Cap Fund, performance of our ELSS Tax Saver Fund, other schemes that we manage in overnight fund. These are the risk beaters, and mutual fund investments are subject to market risk. Read all scheme related document carefully. So now let me quickly sum up what I have so far told in terms of what we intend and why we say that I think timer STP is an alternate route to SIP. So I have already discussed how interest rates have behaved over past 150 years. The current US interest rates can remain longer at current elevated levels because structurally China and other countries are unwilling to finance US deficit through purchase of US treasuries. But let me tell you one thing. This level of interest rates in developed countries means that India will have a lot of inflows for equities, as India is the only large country which can offer double-digit returns to investors. The demographic dividend I was referring to, I have discussed China's economic woes. They all will help India and Indian companies to gain market share of supply chains. Manufacturing businesses will come back to India. India is emerging as a viable alternative manufacturing hub of the world, given the long-term promising potential of India. But there are short-term markets could be heated, given that we have discussed where the small cap index is. Timer STP will truly help investor to capture alpha if market falls in next 2-3 quarters, which the odds are most likely. So yeah, on my part I have concluded. Over to Chirag, and then we will open for questions.
Thank you so much, Umesh bhai. That was indeed a wonderful explanation of how EMOC and timer STP works. Just to summarize for layman, what I understood is EMOC uses a lot of fundamental and technical parameters to derive a value, and that value gives a multiplier input to a timer STP that I would set up from an overnight fund to an equity scheme. And based on the market valuation, if the markets are cheaper, so and I will end up buying more units, and when the markets are slightly expensive, I'll invest consciously, and eventually my dollar cost averaging or average would go down, giving me a alpha. I think that's what I took away from your presentation as a layman on timer STP. We have got a lot of questions, Umeshji. I'll take them one by one. So timer STP is transferring funds from where? Okay, Mohil has this question, and I'll answer that, Umeshji. So Mohil, if you set up a timer STP from A scheme to B scheme, let's say you put up 10 lakh rupees in Samco overnight or overnight fund, and then you can set up a timer STP from Samco overnight fund to a Samco Flexi Cap fund. So based on EMOC value each month, depending on the date of your SIP, date of your timer STP, based on the EMOC value and multiplier on that particular day, the respective amount will get transferred to the Flexi Cap fund. So I hope I've answered your question. Okay, then we have EMOC value
between timer STP and SIP is not correct. In first, we have to deposit lump sum amount. Yeah, so this point is absolutely valid. Timer STP, the requirement is you deposit lump sum and then parking fund, and then the money gets shifted to the target equity scheme. This is correct. But you know what? There is similarity, means what we are trying to say is that there is a monthly fixed amount that goes in an SIP, whatever the market valuation is, the investment is going. But the timer STP will get an added advantage to the investor depending on the market, where the markets are, basis that the installment will get adjusted. So now you are right to that extent that this requires a lump sum commitment, and the SIP does not require a lump sum commitment. It's a regular flow that as and when the investor gets in his account, the money will get deployed. What we are saying is that today India is a solid opportunity. Just by investing a monthly small amount is not going to help. Investors have to have courage and invest a lump sum, a huge amount in markets, because India next 5, 10, 15, 20 years is one of the countries which has the youngest population, has the highest growth rate, a large democracy. Nowhere in the world this kind of return is available. Therefore, he will have to commit aggressive amount. And if he is committing aggressive amount right now in current market situation, for the point that we are driving is market can go little lower, and therefore let's create an optionality for our investor that if he invests through timer STP, it is possible that he will be able to generate alpha if markets fall. But if market doesn't fall, and if markets remain at this level, in any case, by the time for next 1 year, every month an equal amount of installment will go as similar to an SIP. So the timer STP has an added advantage that it will create upside potential, but the difficulty is that investor will have to give lump sum. So that is the true difference. And thanks. This is what the real crux is.
Umeshji, I was just thinking if you can guide us if this is a wrong method or a right method. But let's say if an investor need not necessarily have, let's say, 10 lakh rupee to put it in overnight fund. What I was thinking is if some investor, let's say, has 2 lakh rupees to start with, and he wants to do an SIP of 1 lakh rupee, timer STP of 1 lakh rupees, he can start with 2 lakh rupees in overnight fund, and every month he could put 1 lakh rupee in the overnight.
Chirag, if the investor has 2 lakh rupee lump sum, so every month around 18-20,000, that is a standard installment, will get deducted. But if markets fall, the installment can go to up to double, and it can go up to 6x. And if the markets become extremely expensive, same the 20,000 installment will get reduced to either 10,000, 2,000. So this is the benefit. And to be honest, currently where markets are, it is anybody's guess what's going to happen for next 3 months, 6 months. So if markets fall, more investment will happen, and therefore better alpha. If markets doesn't fall, the steady state return, the investment will still happen. In any case, that was to happen in if had he done SIP.
So we could still recommend investors to develop even a small corpus to start with, and then eventually they could deposit into overnight to make a big corpus and increase the amount of timer STP over a period of time. So there's one question from Mr. Aman and Rakesh. What are the multipliers of timer STP? Umesh, correct me if I'm wrong. It's 0.01x to up to 6x. So if it is 1 lakh rupees, my maximum installment that could go in market during good days, meaning when markets are really fairly priced, would be 6 lakh rupees. And on the upper side, and in a timer STP of 1 lakh rupee, the lower amount could be 10,000. 1,000. Okay. So I hope Rakeshji and Aman, I've answered your question. I'll move on to some other questions that we've got. Why valuation is now getting corrected? Okay. Mr. Gurmeet ji wants to know that, FlexiCap funds underperformance despite of a good portfolio. Was it because of higher valuations, and now, it's getting time correction? So if you could just summarize quickly in 2 lines.
Yeah. See, FlexiCap, we have built a portfolio of high growth oriented companies having solid management, having low debt, having margin of safety, having moats, and have no regulatory overhang. So this was a clear-cut quality portfolio that we have built for our investors, and certain pockets of our underlying assets that we hold are correcting little longer than what we had expected. So typically IT, but I think they are now very, very fairly priced, And we think the sooner the cycle is going to turn, and the portfolio will have the higher benefit of higher exposure to IT. But broadly, I think we have a solid portfolio of high growth oriented companies with all those 6 parameters that I've told you. And this is what is going to drive the wealth. The last 4-5 months, if you see, and if you generally, we don't think that that is a correct way to look at it, but assuming that, you know, what investors are looking at, comparing with the other category, last 6 months, our the incremental alpha that we have generated, our portfolio has generated, is probably the highest. So our fund NAV has increased at a far higher space, far higher rate than any other in the category. So we have solid portfolio. It is only that investors need to be a little patient, and the fruits will slowly start coming in. But yeah, we are confident that this is a solid portfolio for wealth creation.
Got it. There's one question from Mr. Premanshu Das. He wants to probably understand that if you put lump sum in an overnight fund, you know, there'll be debt taxation and unnecessary stamp duty charges, etc. What I understand, Umesh bhai, from your presentation is that overnight fund debt taxation will definitely, the alpha that the timer STP will generate, this will be nominal or probably of an irrelevant amount in the overall scheme of things. If you could just quickly throw some light on that thought.
No, you are correct. See, the time period for that amount will remain invested in the debt fund or the parking fund will be around 1 year plus minus 3-4 months here and there, depending on the market. So, and that generates what around 6.5%, 6.75% today is the return that TREPS is generating. So over there, the taxation part within that is quite, you know, minuscule. When you see the bigger scheme of things, that equity as an asset class, and as I told you, the alpha between normal SIP and STP, assuming that the installment is what we are talking about, the difference is 4%, and this is 1.5 years. So the difference can be huge, you know, over in a long period of time. But at the same time, investors also want this, that I want a little more in short term. So if they want a little more in short term, then okay, this is the route. You will have to bear a little bit taxation of debt, and timer STP is a viable option.
Got it. Follow-up question in the same probably line of thought is, you know, SIP is generally once a month. What if the market continuously falls for 2, 3, 4, 5, 6 quarters and so on? So how will this timer STP will be effective during a fall? Now, one line again, I would quickly summarize what I understood. If markets are falling, the multipliers will keep increasing and more units will be bought at a lower price if the markets are consecutively falling. So if, you know, if that's the correct explanation to Pankaj's question.
Yeah, I think, Chira, you have pointed it right. If markets are falling, assuming that for the sake of simple argument that monthly fixed date when our MOC will be checked, if markets are lower, a higher multiple will go. But again, next month, if again the markets are lower, again a higher multiple will go. See, generally over a period of 25 years, we have not seen that only 1 month that option was available. And within that 1 month, there were only few days which our STP was not triggered on those few days and market can go higher. That does not happen. Markets take time to correct, and investor will have an opportunity to get his date when the markets come. He will also his share of higher installment when his turn comes on that particular day. Just one day market comes down and another day it is up. So I think those 1 days that people can be lucky if on that day that timer STP has been triggered. But fairly, what we have seen over a period of time, that if markets are falling, it takes its own time and investors will have an opportunity to invest more. But if markets are not falling, so markets will remain where they are, and normal installment will be invested, and he will still get the benefit of SIP returns.
Got it. So taxation we've already covered. Timer STP can be executed from samcomf.com. Empanel partners can log into their distributor dashboards and can initiate transactions from there, or take up a physical application form and register a timer STP. Our relationship managers will have a lot of more material to share with you on timer STP. Excuse me. I would recommend to all the Empanel partners that you reach out to your relationship managers, and they will come and share live use cases of how a timer STP in Samco FlexiCap fund would have fared against a normal STP or an SIP. That's an interesting live case that our relationship managers would share with you in person meeting. So I would request you post this call. I will request my team to shoot an email to all the Empanel partners with their relationship managers' name and numbers. I would urge you to reach out to them and understand these live use cases, and it will definitely benefit your investors. With that, I think Premanshu Das, is it possible to introduce timer SIP? I would say that you are on the right track, but still a little more time for that product to roll out. Gurmiji, thank you so much. This product should be available on BSE and other platforms, is what he's saying. I would take that as a compliment that this product is powerful and probably can give benefit a lot of investors. I would, to all the attendees, I would stick to questions on timer STP, EMOC, and FlexiCap. There are a lot of sector specific questions and questions on active momentum fund. Soon we are going to do a deployment call on active momentum fund where we'll discuss the strategy for that. For this call, it would be really great if we could all focus on timer STP and EMOC questions so that we understand this concept really well and take it to our investors. Okay, I think Umeshji, we've covered mostly all the questions. Good, around 50-60 questions, but we've clubbed it into a certain set of questions. So once again, on behalf of the whole Samco Mutual Fund team, I would like to thank you for taking out time today. I hope, and I'm very confident that we've delivered value on this call with a product like timer STP and how it works. And I would urge you to take this product to your investors and help them generate alpha in this market. Once again, do reach out to your relationship managers for more information and leaflets on timer STPs that you can use to market it to your customers and investors. Once again, thank you so much. I'm Chirag Joshi signing off from today's Distributor Digital Meetup. Thank you and good evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.